How venture capital works. Funding ideas before they make sense on paper. Most businesses do not start fully formed. They begin as ideas. Sometimes rough ones. Sometimes with no revenue, no customers, and not much more than a plan. And yet, some of these companies still receive millions in funding. That is where venture capital comes in. It is a system designed to invest in early-stage companies with the hope that a few of them grow into something much bigger. So today we are going to walk through how venture capital actually works and why investors are willing to take these kinds of risks. Chapter 1: What venture capital is. Venture capital is a form of investment in early-stage companies. These are typically startups that have high growth potential but also high risk. Instead of lending money, venture capital firms invest in exchange for equity. This means they own a portion of the company. If the company grows in value, their investment grows with it. Chapter 2: The investors behind the funds. Venture capital firms raise money from investors. These investors may include institutions, pension funds, and high net worth individuals. They commit capital to a venture fund, which is then managed by the firm. The firm decides how to invest that money across different startups. Chapter 3: Finding startups to invest in. Venture capital firms look for startups with strong growth potential. This might include innovative ideas, scalable business models, or strong founding teams. The selection process can involve reviewing business plans, meeting founders, and evaluating markets. Because many startups fail, choosing the right ones is critical. Chapter 4: Funding rounds. Startups typically raise money in stages called funding rounds. Early rounds may include seed funding, followed by Series A, Series B, and so on. Each round provides additional capital as the company grows. At each stage, the company's valuation is reassessed. Investors receive equity based on that valuation. Chapter 5: Ownership and equity. When a venture capital firm invests, it receives shares in the company. This represents partial ownership. The percentage depends on how much money is invested and the company's valuation. As more funding rounds occur, ownership may be diluted as new investors come in. Chapter 6: Supporting the startup. Venture capital firms often provide more than just funding. They may offer guidance, connections, and strategic support. This can include helping with hiring, partnerships, or business development. The goal is to increase the chances of the startup's success. Chapter 7: High risk, high return. Venture capital involves significant risk. Many startups do not succeed. However, the ones that do can generate large returns. A single successful investment can offset multiple unsuccessful ones. This is why venture capital focuses on high growth potential opportunities. Chapter 8: Exiting the investment. Venture capital firms eventually look to exit their investments. This typically happens through a sale or an initial public offering. An IPO allows the company to become publicly traded. At this point, the value of the investment can be realized. The firm may sell its shares and return profits to investors. Chapter 9: How firms make money. Venture capital firms earn money through management fees and a share of profits. Management fees cover the cost of running the fund. The profit share, often called carried interest, rewards successful investments. This structure aligns the firm's incentives with the performance of its portfolio. To wrap up, venture capital works by investing in early-stage companies in exchange for equity. Firms raise funds from investors and allocate that capital across startups. These investments are high risk, but successful companies can generate significant returns. Funding occurs in stages, and ownership evolves over time. Ultimately, venture capital firms aim to exit their investments at a higher valuation. Although uncertain, this system plays a key role in supporting innovation and new businesses. This has been a mini Leviathan production. If you enjoyed it, check out our other videos. See you in the next one.